Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. Tesla posted record Q3 production and delivery numbers, once again blowing everyone away. In this video, I'll talk about what it means for Tesla's Q3 earnings, profitability, possible S&P 500 inclusion, potential impact on Tesla's stock price, and more. If you own or are interested in Tesla stock, stick around. To those of us with our finger on the pulse, Tesla's record production and delivery numbers were inevitable, and mark my words, every quarter for years to come will see a new record for both production and deliveries, yet the wider stock market still seems oblivious to this. In the interest of full disclosure, I'm still buying Tesla stock today with a sense of urgency. I don't plan on selling a single share for at least a decade, and I feel that with each subsequent record quarter, the buying opportunities for Tesla stock will further diminish. In a sense, I'm trying to accumulate as much Tesla stock as possible before everyone fully gets it, and I'm not sure how much time I have left. So, let's get into the video. But first, hey guys, if you live in the US and would like up to 2 free stocks valued up to $1,600 each, use the link in the description to WeBull and deposit $100 in your account. Each of these stocks will be a minimum of $8 in value, so if you suck at math, that is a 16% ROI on $100. Not bad. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake, also using the link in the description. Let's get back to it. Tesla is gaining market share. While Wall Street analysts, for the most part, have their heads inserted firmly into their behinds and are prone to fixate on irrelevant data points regarding Tesla, the one thing they can't ignore is the fact that, as I predicted 6 months ago, Tesla is gaining market share relative to other automakers. I mention this only to front-run the potential mainstream reactions to whatever results Tesla posts for Q3 earnings. There's a strong chance the narrative will focus solely on Tesla and ignore completely the fact that Tesla is eating everyone's lunch and gaining a further lead. Don't be that foolish. Whatever Tesla's results, view them in the context of the wider market, not in isolation. Model Y is a money printer. Model Y, which accounted for about 1/4 of vehicle deliveries in Q3, sells for $3,000 more than the equivalent Model 3 does. Unsurprising, given it's about 10% larger. But Tesla has already told us Model Y is cheaper to manufacture than Model 3 thanks to boundless innovation, refinement, simplification, and improvements in the manufacturing process. And in case you haven't noticed, Tesla continues to find new ways to do more with less, and as a result, can keep driving prices down or enjoying even healthier margins, or both. At the very least, this means that every Model Y sold in Q3 will add $3,000 plus to the bottom line, possibly more. In other words, expect fat profits. Production and deliveries. Tesla produced 145,036 vehicles and delivered 139,300 in Q3 2020. Both records, and neither a surprise to anyone paying attention. Tesla's next best quarter previously was about 25% less deliveries. This means it's all but inevitable we'll see record revenue, record profitability, and record free cash flow as a result. Need I remind you that we are on the tail end of a pandemic? For Tesla to navigate forced factory shutdowns, massive supply chain disruption, and huge logistical challenges to both produce and deliver record numbers of vehicles is an incredible feat. Product mix and profit margins. Automotive sales account for around 85% of Tesla's total current revenue, with Model 3 comprising around 2/3 of sales, Model Y around a quarter, and S and X the remainder. We also know that the made-in-China Model 3s are far more profitable than their US counterparts. This, combined with the money-printing Model Y, suggests we can expect very healthy margins, even if most vehicle sales are low-spec models. Q3 2020 is where we feel the full force of Gigafactory Shanghai for the first time. Cash on hand and profitability. Tesla has officially become a money-printing machine. They finished Q2 2020 with over $8 billion in cash, also known as a metric shit ton. Since then, they've also sold around $5 billion in stock, creating a $13 billion war chest and posting 4 consecutive quarters of profits. And that's all before Q3. Mark my words, Tesla today is a highly profitable cash machine. Half of Wall Street still doesn't recognize this. Their loss. I expect Tesla will produce on the order of $1 billion in free cash flow this quarter, resulting in a mountain of cash and record operating income to the tune of hundreds of millions of dollars. Tesla's biggest challenge now is spending the money. I mean, really, with 2 enormous factories currently under construction, Austin and Berlin, continued expansion at Shanghai, and improvements at Fremont, it's hard to see how Tesla could be moving any faster. There's only so many great engineers out there. Moving forward, Tesla's biggest challenge may be avoiding the accumulation of excess cash. tough problem to have: full self-driving and other software revenue. As Tesla creeps incrementally closer to solving fully autonomous driving and releasing new features, they incrementally recognize more revenue on prior sales of the full self-driving package. No doubt, the take rate on their $8,000 full self-driving package continues to increase in line with its functionality. This package, being software, is almost pure profit. So too the over-the-air updates like acceleration increases, heated seats, and so on. As time goes on, Tesla continues to turn on more high-margin software revenue, and we'll see more of this in Q3. Zero-emission vehicle credits. As I've mentioned previously, every vehicle Tesla produces gives off a waste product that Tesla can't use, but other companies will pay big bucks for. Zero-emission vehicle credits. I'm not even kidding when I say other automakers are paying Tesla hundreds of millions, in some cases billions of dollars, to buy these waste products. Tesla doesn't need them to avoid fines because they only make emission-free vehicles. Other automakers, however, are struggling to make enough electric vehicles to avoid enormous fines, and so they're buying these ZEV credits from Tesla. Yes, Tesla's so-called competition is literally paying for Tesla to build gigafactories. ZEV credits are literally free money, and until legacy automakers can get their shit together, expect Tesla to continue to make hundreds of millions of pure margin revenue selling ZEV credits to competitors every quarter. What a strange world we live in. And to the three dingbats ready to tell me how Tesla can't make a profit without selling credits, please think a little bit deeper about how finances are managed within a multi-billion-dollar company, and then think some more, even if it hurts, about the fact that Tesla could actually be taking actions based on their knowledge of the current availability of cash from these credit sales. You know, like spending the money to accelerate their mission because they already have too much cash and would rather scale production than please basement-dwelling Tesla shorts, logically impaired analysts, and deluded bears who somehow think a temporary source of revenue should be completely disregarded, even if it's enough to build a new factory or two every year and shows no signs of slowing down. Solar deployments. Today, solar is a blip on Tesla's radar, but Q3 saw a very strong push towards solar with Tesla, for a time, featuring solar on their website homepage rather than a vehicle. We also saw Tesla hiring aggressively for solar glass roof installers, and most importantly, claiming to have the cheapest solar in the United States. With an average solar glass roof sale price around that of an entry-level Model 3, it's only a matter of time before solar revenue explodes. The limiting factor is Tesla's ability to ramp production and find installers. We'll learn more about this when results are announced. Battery deployments. Tesla's battery business continues to go from strength to strength. We've seen recent price cuts and a number of new large-scale storage projects announced. Given the lumpy and unpredictable nature of storage, one project alone could be 10, 20 or 100 times bigger than the average. It's hard to know what to expect for Q3, but like solar, it's only a matter of time before an inevitable explosion in growth. China. You may not know that in the first half of 2020, Tesla took an 82% share of the US EV market. Astonishing, to say the least. Of course, China is a different animal. With hundreds of EV makers, a mature market, and a supportive government, China is awash with choice for EV buyers. Yet even so, through the first half of 2020, Tesla took a truly unbelievable 21% market share of new EVs in China. In Q3, Tesla cut prices and almost instantly, local reports of huge lines and Tesla staff staying back doing hours of overtime to clear the backlog surfaced. Tesla's highly profitable made-in-China Model 3s are selling like hotcakes. This will make a meaningful impact on Q3 financials. Guidance. In case you forgot, when the world was ending in early 2020, people were panic selling their stocks, crying for their daddy to hold them, and calling me insensitive for telling everyone to calm the fuck down and think rather than react. I also predicted that in Q2, Tesla would not update their delivery guidance. It was a bold call at the time, and I was right. Surprise, surprise. Tesla is still aiming to deliver 500,000 vehicles this year, a figure they guided for in 2019 before the pandemic, yet they're still on track. Why? Tesla told us they were confident in comfortably exceeding deliveries of 500,000 units in 2020. While no longer comfortable, this goal is still highly probable. I expect in Q3, Tesla will reiterate 500,000 plus units for 2020. It won't be easy, but nothing Tesla does is. Should Tesla meet their 2019 guidance of 500,000 deliveries, despite a fucking pandemic, forced factory shutdowns, and huge disruptions to supply chain and logistics, it will be a miracle and should send shockwaves through Wall Street and the automotive industry. To meet this goal, Tesla will need to deliver about 180,000 vehicles in Q4 2020, close to double their full year 2017 deliveries, and I think they'll do it. S&P 500 inclusion. And last but not least, S&P 500 inclusion. I was shocked, yet somehow not surprised that the S&P 500 did not announce Tesla's inclusion after they posted their 4th consecutive quarterly profit and became eligible. After all, the anti-Tesla bias runs deep, FUD is ubiquitous, and many trillions of dollars of industry want them to fail. Will 5 quarters in a row be enough to do it? That's anyone's guess. It should be, but I won't hold my breath. Part of me suspects the S&P 500 board is waiting for Tesla to post profits that, even if ZEV credits are backed out, still remain positive. I think they've been buying into the FUD. But whether it's this quarter or later this decade doesn't matter to me at all. All I care about is how well Tesla is executing versus everyone else. Conclusion. Q3 will be a blowout quarter for Tesla, chock full of records including record production and record deliveries, which we already knew about, record revenue, record cash on hand, and a record profit. And you know what? These records will only last 3 months before they're smashed again in Q4. Tesla is growing rapidly, becoming more efficient, driving costs down, increasing margins, expanding their global footprint, embarrassing everyone trying to compete, running circles around legacy automakers, gaining massive market share, banking billions, expanding while others contract, and doing nothing but a whole lot of winning. We're witnessing the end of the ice age at the hands of Tesla. My only question now is how long until everyone can see this obvious fact. Until then, I'm still buying Tesla stock because I don't think the wider market knows what they're looking at. Yet. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget your free stocks with WeBull and stake using the links below. Open a new WeBull account, deposit $100 and you'll get 2 free stocks valued up to $1,600. And stake, spin the roulette wheel, you'll either get Nike, GoPro or Dropbox. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.